Investors just got blown out of the water by ContextLogic's reverse stock split, but it may not be as gloomy as you think.
Say what?
Hi again everyone, I hope you're all doing well. So investors may be feeling a little bit apprehensive at the news of a 1-for-30 reverse stock split for ContextLogic, parent company of retailer Wish.com, which also trades under the ticker symbol Wish. While the move may seem like cause for concern, there's more to the story than just a plunging stock price. First, let's take a look at what the stock split actually means. In simple terms, it's a way of a company to reduce the number of outstanding shares while increasing the value of each individual share. This can be seen as a positive move as it can make a company's stock more attractive to investors who prefer high-priced shares. Additionally, reverse stock splits can be a way for a company to regain compliance with exchange listing requirements, which is the case for ContextLogic, as they've been trading below the $1 mark for some time now. So what has led to the need for a reverse stock split in this case? So ContextLogic has had a rocky start as a publicly traded company, and that's no secret, with revenue slipping from $2.5 billion when they first listed, dropping to $2.1 billion the next year, and continuing to decline to $571 million in the last financial year, which led to a net loss of $383 million. So it's clear that the company has struggled with profitability, and its massive expenditure on digital advertising has not been fruitful while being the key driver of traffic to the website. However, it's important to note that the company still has strong cash reserves and has not had to engage in equity raising in the time it's been publicly listed, which is a positive sign. Additionally, while the reverse stock split may cause the stock price to drop initially, it can actually be a step towards improving the financial health of the company in the long term. By reducing the number of outstanding shares, the company can reduce volatility and increase the value of each individual share. This can make the stock more attractive to institutional investors who prefer higher price shares and can lead to increased demand for the stock. The reason they like higher price shares is they don't like the volatility, which a lot of retail traders like because they like to swing with the movements. Anyway, additionally, it can improve the company's financial ratios such as earnings per share, which can be a positive sign for investors. It's also worth noting that reverse stock splits are not uncommon in the current market, with many companies utilizing this strategy to regain compliance with exchange listing requirements. In fact, according to S&P Global Market Intelligence, there were 45 reverse stock splits in 2022 and 20 so far this year in 2023. So overall, while the news of a reverse stock split initially seems concerning, it's important to look at the bigger picture. ContextLogic is taking steps to improve its financial health and regain compliance with exchange listing requirements. While there may be short-term volatility, this move can ultimately be a positive one for the company and its investors. It's also important for investors to continue to carefully evaluate the financial health of the company, as profitability remains a going concern. However, with cash reserves still in place and hopefully a plan to improve listing quality and trust, there are reasons to be optimistic about the future of ContextLogic and its stock. We just need to see if they can deliver on a plan that's going to bring any meaningful improvement to the business. Anyway, what are your thoughts on this update from ContextLogic? Is this another step towards the company's slow demise, or do you think it gives the board breathing room and will return some stability to the stock price in the longer term? Let me know your thoughts in the comments below. Until next time, everyone, may the markets trade in your favor. Cheers.